All right, so good evening and welcome to this lecture on the anti-avoidance measures. So basically, we have learned tax planning and we want to look at the anti-avoidance aspect of it. So the whole idea is that you have been able to plan your tax, but in as much as you are planning your tax, the Commissioner General has some reservations about your planning of your tax. And so what they do is that there are some provisions in the law that the Commissioner General can actually use to block some people from doing those kind of tax planning activities, especially those that are aggressive tax planning. Please, I hope you can see my screen.
Yes.
All right. So basically, that is that. Now, we are going to look at, there are about 7, and we've done 10 capitalization. So it means that we are going to deal with the remaining 6 tonight. Let's hope that we have the time for that. So when we talk of the anti-avoidance measures, we are talking about the provisions implemented by the tax authority, i.e. GRA, to actually prevent some people from exploiting the loopholes, all right, and engaging in some kind of artificial transaction just so to reduce their tax liability. So we know that people will plan their tax, and the essence of the tax planning herein is to reduce their tax liability or increase their tax savings. But in as much as people are doing that, the law has empowered the Commissioner General to regard certain form of arrangement that he sees as fictitious. It's like what you are doing is to kind of bully the law to save yourself from paying tax. So the first one that we are going to look at will come from section 34. All right, that is the one that we call general anti-avoidance rule, the general one, general anti-avoidance rule. Now, the concept of the general anti-avoidance rule is simple. It is basically saying that if the Commissioner General sees a transaction that the transaction is fictitious, if the Commissioner General feels that your transaction has no economic effect, so no economic effect, but you are just using it to kind of have your way around the tax, i.e. your transaction that you are doing does not reflect the substance, then it means that what is going to happen is that the Commissioner General can decide to disregard your arrangement. All right, he can decide to use his powers to deem that thing as a transaction that you are just aiming to reduce your tax liability. Let me give you a typical example. When we were doing the free zone, we did a transaction and an example that says that a free zone entity, and this is a revision for you guys, we said that they must export majority of their products and trade the others import. Do you remember the percentages? How much of it is supposed to be for export and how much of it is supposed to be for local market? It's not really important.
75.
Local market.
I think it's 75-25.
Are you asking or you are answering the question?
I'm answering.
Because I heard you say, is it? Yes, the others. What is the percentages? So he says 75 or 25 and 25. Yes, the others. Unless you are telling me that you have not been learning. And these are serious areas you cannot take for granted.
Yes,
Yes.
so we can look at 25. We have 25%. We have exports, which is 70%.
But 70-25 is not 100%.
Okay, the thing is that I think so. That's what I've learned of.
You said?
So that export is 70% and the trade is 30%.
So you are saying it's 70-30. So which one is which? So it suffices that when you are learning these things, you have to be very, very careful because these are matters of law. You don't use assumptions. I always tell you that when something is about law, feelings don't come in, and I think don't come in. It is what the law says. What the law says is what the law says. All right. So yes, I want to give you one last chance. Yes.
So okay, I remember that we said that after 10 years, the chargeable income is
No, it's not about the 10 years. I'm talking about the quantum of their production that is supposed to be for export and import.
It's 70-30. It's 70-30.
All right. Okay. So that is that. Now, with that settled, you realize that we did an example that also said that, so the one that famous you were trying to go to, that after 10 years, the local trade is taxed at what rate?
the domestic is 25%.
25%.
25%. And what about the export?
That's the
15%.
15%. Now, we did an example, if you remember in class, where the export of this free zone trade was a non-traditional product. So what was the tax rate for the non-traditional product? See, this is revision. Yes, tax rate for non-traditional exports.
18%.
Come again.
18%.
I can't hear you. Is it 8 or 18?
18.
18. That's wrong. It's 8%. So guys, you have a lot to do. It looks as if you have not been reading. Yeah, that's the meaning. Yeah. So please do that. And I have shared the video with you that nobody teaches withholding tax. These are rates of taxes. You just have to know them by heart. All right. And I remember that when we were doing these things, I said that there was a case where after the 10 years, the free zone enterprise was exporting non-traditional products. And so they decided to apply 8% instead of the 15%. And this became a court case because, and that is where all these things come from, because the guy is trying to bully the whole concept around to apply 8%. So the court adjudged that this non-traditional export, that is 8%, is for entities other than free zone. So it means that if you're a free zone person and you are dealing with non-traditional export, then it means that you are going to apply 15%. So you see, the whole idea is that, and that thing is part of the general anti-avoidance rule. Because you being a free zone and you know that your export is 15%, yet you want to corner your way around it to apply 8%. The GRA, the commissioner, has the general anti-avoidance power to say that, no, what you are trying to do is fictitious. So that is it. And so because of that, those arrangements, and this is it, an arrangement refers to any action or agreement or a transaction that can be enforced legally. So he's saying that this type of arrangement that you have done, you as a free zone entity applying 8% is deemed fictitious. And therefore, he will amend, recharacterize it, all right? And so let you pay the 8%. So the general anti-avoidance rule is just saying that there are rules that are designed to prevent the tax avoidance scheme. And those ones that are not specifically addressed in the tax provision. In the tax provisions, these things are not there. There is no emphatic statement that says that free zone non-traditional export is 15%. No, it's not there. But this became a court case. And by that, it was deemed that this one is fictitious and the person is just trying to bully the provisions in the tax law. And that is why they disallowed the 8% from happening. So that the general anti-avoidance rule is saying that generally, the Commissioner General is empowered to disregard certain transactions that are carried out just for the sole purpose that you are trying to do an aggressive tax planning. All right, so that is that. For example, again, we did location variable. And I remember when we were doing location variable, I did something like this. So we have, you guys told me that the junction between Central region and Greater Accra region is Kaswa. So we have Kaswa and Accra. So if now somebody tries to build a factory here, a manufacturing entity, he tries to build a factory, then this is where the factory is located. This is where the factory is located. As you can see, there's a part of it that is entering this place. But the person now decides to apply the Kaswa rate of 12.5. So Kaswa is 12.5% for a manufacturing company, but here is 25%. Now, if you do this just because there's a kind of part of your wall in Kaswa, then it means that you are trying to circumvent the thing to suit your purpose. And the Commissioner General has the right to say that there is part of your office in Accra, and so therefore, since you are applying the 12% just so that you can bully your way around, he can deem you to be in Accra so that you pay the 25%. So that is the whole thing about the Commissioner General. And don't forget that this is what happened. This empowerment is actually for the CG, the Commissioner General. But we all know that Commissioner General has the right to delegate some of his authority, notable these ones, to the commissioners, not the revenue officers, but to the commissioners. So most of the time, in reality, this thing is done by the DTRD man. I think that is Mr. Jamra. So most of the time, this is it. And if you remember the free zone case that we did, he was the one who was beneath it, whose name was beneath it. So these are the things you see. At this point, that is the general anti-avoidance rule, and that is the idea behind that. So if you have any question, you can ask at this point. Before we go to the change in accounting year. So the first one was general anti-avoidance. It's a general one, but there are specific ones. And the specific ones, first one that we are going to look at, which is our point 2 today, is about change in accounting year. Now, first of all, what you are supposed to know that the change in accounting year is only eligible for trusts and companies. Anyway, how many the entity variables, how many are they? Yeah, how many are they?
I think there are 4.
Mention them.
Sole proprietorship, partnership, then company and trust.
All right. So that is that. Okay. Now, the company and trust, they pay their taxes according to their accounting year. So we know that accounting year can be January to December. It can be January to December. It can also be any day, like let's say 30th April to that will be 31st March. So any 12 months. Now, so let me put years here. So January 2023. So let me write it well. And you are going to answer some questions for me. So we have January 2023 to December 2023. That is somebody's accounting year. Now, if this person's accounting year is this period, what is the last day that he is obliged to file his final tax for 2023?
April.
You have not ended. What is the meaning of 30th April? 30th April is
30th
not
April
24.
30th April 24. Okay. If the accounting year starts from, let's say, October 2015 to September, right? That is what it will be, 2016. What is the obliged date for the final tax filing?
31st January 2017.
31st
January 2017.
2017. So meaning that it is 4 months ensuing the end of the basis period. All right. So that is that. So if you count 4 months, October, November, December, 31st January 2017. Now, this is good. Now, we have situations where people want to change their accounting year. And the way they change is, if it is not well taken care of, they are likely to dodge some payment of taxes. Very, very likely. And so people might want to change the accounting year just so to avoid some tax payments. It's very possible. Now, let me give you a typical scenario. Let's say that my accounting year, and I can even decide to use this date. So let me say this one will be, let's say initially they were doing January 2023 to December 2023, 31st December 2023. All right. Now, let's also say that this people has a profit of 100,000 for this period. Of course, Accra Tema, so let's assume 25% tax rate. Now, let's assume again that their next year, of course, will be January 2024 to the 31st December 2024. And their profit perhaps is, let's say, 200,000 Ghana cedis, also to be taxed at 25%. Now, this is what they do. Now, in January of this year, what happened is that in January this year, what happened is that they decided to change their accounting year to end at September. End at September. So that is what they've decided to do. Now, and I can go on, but we will solve an example, but I just want to use these two periods to show you. So first of all, if you want to change your accounting year, you have to apply to the Commissioner General in writing, all right? And you give reasons why you would want to do the change. And before this thing will be giving you the allowance of you allowing of you changing your accounting year will be giving you, you must have filed all relevant returns and settle all your taxes and also settle all your penalty due. Now, if you fail, then it will be revoked. If you fail any of the conditions, it will be revoked. Now, let's look at the mathematical essence of why somebody would try to change his accounting year. Because you see, if he changes the accounting year from January to September, and if that one happened, like from henceforth, he is going to do the account from October to December. That will be ending in September, means that it will start in October of 1 year to September of 1 year. Is that not it? That is what will happen. So if they are doing this, then what is going to happen is that they are going to, the accounting year should start at October 2023 and end in September 2024, right? Are you with me on this?
Yes.
All right. So that one will mean that these people will pay a tax of 25% on their 100,000. That's the first thing that will happen. That's the first thing that will happen. However, instead of paying tax on the entire 200,000 for the second year, they are saying that the accounting year ends in the 9th month. So what is going to happen is that they are going to pay tax on a 9/12 amount of this. Now, if care is not taken, the following year must be checked, because if the following year too is not really, so because look at this, he has paid the October 2023 one is inside this place. That is what you see. It is inside this place. So he has already paid 25%. Now, if care is not taken, what an entity is likely to do is that they may even shorthand this one to 9 months and also shorthand this one to 9 months, reducing the 3 months difference from the money that they are supposed to pay as taxes. To better illustrate this for you, I think that I have some examples I have here to better illustrate it for you well. Now, look at this. If you change your accounting year, this is what is going to happen. Your first period, according to the Commissioner General, will be the law will be the first 12-month period ending at your previous accounting year, and we will look at that. So it will be your previous 12 months. That is that. So if you want to change this one like this, from October to September, then your first 12 months previous will start from October 2022 and end in September 2023. That is what we are saying. Your first 12 months, your first period will be 12 months period to the end of the previous accounting period. So that is what will happen to you because you want to do the change here. So the change must happen so that your October must be always a beginning. Now, look at this. Look at this. I'll show you something on that. Then the second period will start from the day the previous period ended to the new period you want to do. So I will show you that one too. Then your third period is the next year, which is now into your change that you wanted. And there has to be no overlapping. There has to be no gap. Now, this is what I'm saying. Look at this. Look at this illustration. Look at it very carefully. Look at it very carefully. That is what I wanted to do here for you, but look at it very carefully. Now, you see that this is the trust prepares account for a short period ending in a year of change. Now, look at the illustration very carefully. Stephanie prepares account to 31st December each year. That's what they do. Now, in January 2016, the company applied to the Commissioner General to change the accounting year to September. Now, in order to avoid gaps in it, we are looking at these three things. This is what we are talking about. In order to avoid a gap, because if the Commissioner General doesn't take care, you elude some gaps in it, which you will dodge paying tax for it. And so they apply these three things. So look at the situation here. Look at it very carefully. Look at it very carefully. So do you see that they want to change to September each year? You see, year 2, since they prepared the account to 31st December, year 2 means that it is from 1st January 2015 to 31st December 2015. That is the meaning. And the profit amount you see there is 200,000. Then the second one that you see, period 2. Period 2. Now, period 2 doesn't mean year 2. All right, it doesn't mean year 2, because you will see that the period 2 is the period they want to now change their accounting year. So that presupposes that it is from also 1st January 2016 to 30th September 2016. So this is what you see. And that figure there is 300,000. Then they continue from 1st October 2016 to 30th September 2017. And that you see 450. Now look at it very carefully. Is there an overlap? Have they dodged a year in trying to change? Have they dodged some months in trying to change their accounting year? Have they dodged something? Have they dodged any 3 months within it? Because the change between, I think, September and December is always 3 months, right? October, November, December, kind of. But do you see that they have dodged a month or anything?
I think they've consumed some 3 months off.
Where?
Because when you look at the year 2, that one is a full year. But when you come to the period 2, which means that it's 9 months instead of the 12 months.
Okay. What about the third year? Because I see that the third year contains the short 3 months in it. So year 2, meaning that from the new year they've changed, because the change is happening. They wanted to change in 2016. Yes. Who else sees? For what I see, they've augmented the short months. What I'm trying to say is that you could see clearly that even though the profit they made here is just for the 9 months, and this one that is starting year 2, this one is showing clearly that the 3 months after 2016 is within. So it means going forward, the accounting year will now be October to September, like that. So this one is actually a 9 months profit, exactly, not prorated. I don't know if you see what I see. It wasn't a 12 months profit just because of the word period. The period to period. If it had been year 2, it means that it would have started from behind, like October, because this one is period. It's not a year. Year 2. So indeed, this one, what you see is that the change is so perfect that there is nothing for you to, there is no gap in it. The change is so perfect. I don't know if you see that. The change is very perfect. There is no gap, shortfall in payment of taxes or overpayment of the taxes. Have you seen that?
Yes, please.
Yeah. But look at the second illustration. So this one, the years of assessment are clear. Everything is okay. There's no need to prorate anything. But look at this second illustration and look at it very carefully, because this one, there is nothing like period two. It means there are years two. Now, so it tells you that this one, what you see, you have, it said year two. Year is 12 months. So it will be January 2015 to 31st December 2015. So you see 200. Then the next one says year two. Year two. And they are changing the year in January. So year two here means that it is going to start from October 2015 to September 2016. And the profit there is 300,000. Then from there, they continue because that is where they wanted to change. So it now starts from October 2015 and clearly ends in the next September 2017. So you have 450. Now, what you see in here is tricky. If you see what I see, well, let me ask you, what do you see? Is there an overlap? What do you see?
Yes.
Yeah, so show us.
There's an overlap with the dates. Okay, so all of them says year two, which means that in 2015, October to December is included, and also for the year ended 2016 to October to December 2015 is also included. So the same amount will appear in two separate accounting periods.
Yeah, so between somewhere here. So in that case, since the law said that our first accounting period will be 12 months behind us, the first 12 months behind us, indeed, is this one. Don't forget what we are doing is based on law. So this statement, the first period is the 12 months period up to the end of the previous accounting year. So up to the end of the previous accounting year is this. That is what you see here. This is the previous accounting year. At that time, the change had not happened. The change had not happened. Then the second 12 months, that is where they proposed the change. The second 12 months start from the day after the end of the previous 12 months. So it should have started from January. So that is where it should have started from. And to the end of the new period. So it should have started from January to September 2016 with attention paid to any overlaps. The problem is always the second year. So this one, you could see that there is overlap. There is overlap because this October 2015 is already within here. So therefore, the money that is here has to be prorated for 9 months. You see the difference between this one and this. So this one started right from January. So there wasn't any overlap. So our previous 12 months is here. Then we continue from where this one ended. So you could see. But you see, this one, year two means that they've gone back. So the money in here is also in here. And so therefore, we have to be careful and do 9/12 of this figure. Just to say that the 9/12 is starting from January to September. So what you need to be careful about is when the question uses this word period two and uses this one year two. So that is it. You have to be very, very careful. So because of that, we will be prorating, like you see here, we will prorate this figure so that it will end in September, and our next one will also able to start from October. Now, I want you to now use this understanding to do this one. Everyone, do this. Do this one. So XYZ prepare account on 31st December each year. In January 2016, the company applied to the Commissioner General to change the accounting year to June, all right, to end at June each year. The companies, these are the company presents 3 accounts stated. So year 2, I think there is one amount missing. There's one amount missing. So let me get it for you. Yeah, so it is the arrangement that is wrong. So year 2, the year 2 is this. Year 2 is 200. Period 2, and it's 150. So please, that's the amount. Then year 2 again is this. So I want you to try. How will it be for the 3 accounting years? Don't forget they are changing into June. So please note that. Will there be a proration or there will not be? So find it out and let me know.
There will not be.
There will not be. Just because of the period 2, right? Which
There will
means
not be
that,
any gap.
yeah,
Yes,
there will not be
because
any gap.
the period 2. Yes.
Yeah, meaning that I started from January and it's for only 6 months, and this one, so the next one will, year 2 will mean that it will start from July 2016 and end here. All right, it's good that you're able to quick see that. All right, so that is that. So just take note of the year 2 and the period 2. That is the thing you need to be careful about. All right, so that's good for you to see. So we've done general anti-avoidance. We've done situations where change in accounting period is in. Then we are looking at the third one. The third one is about quantification using fair value. Quantification. Now, there are certain things that, I mean, it's very difficult to determine their value. So, for example, if I give you a gift and I don't tell you the price, and you are supposed to pay gift tax on it, the question is that, what is the value of the thing such that you pay the gift tax on it? So you need to have an amount. Now, if the amount is therefore difficult to determine, so here, this is what Section 28 allows for. So it says that this provision relates to the quantification of payment or amount to be included or deducted from income. This amount is quantified. So like we said, you have to determine fair value, but there are procedures to the determination of the fair value. So when it comes to the quantification of benefit like accommodation, vehicle, and loan, of course, this is in employment income. We use the 4th schedule. The 4th schedule, that is what we use. Then we can also use regulations. Regulations are called LIs, legislative instrument, or we can use according to the market value, how much the thing is worth. And market value is coming from your corporate reporting and FR thing, which is IFRS 13. So how much the thing will cost in an arm's length transaction, all right? So that we are not looking at it in terms of a related party transaction. So some are given by 4th schedule. So if you want to, you see, it is very possible for you to price something which in the fair value in the active market is to say 50,000, but just because it's related amongst you, you price it at, let's say, 20,000. It's possible, very, very possible. Now the Commissioner General has the power to now say that let's use the market value. How will it have been between knowledgeable market independent knowledgeable market participant at a measurement date? How will it have been, i.e. an arm's length? So he can decide to use an arm's length transaction to adjudge every transaction that you do among yourself. So that is another thing that the Commissioner General has power to do, using that quantification. All right, so that is that. It seems obvious that that is what he should do anyway. So basically that is that. All right, so then this one is the one that is a little tricky. And I think that I've explained this thing in the face-to-face class before when we were doing the tax planning. It is a situation whereby a person indirectly benefits from a payment. And I remember doing some illustration like this for you. So we have party A and we have party B. Now, A is supposed to make payment to B. Now, when B takes the payment, it means that B has taken the money directly. But B says that, oh, let's say this one is based in the US and this one is based in Ghana, and the money is supposed to be in USD anyway. But B will say that I have a son who is studying at US. So give the money to my son. You see, the son is in US, so A will give the money to the son. And that is assumed that he has paid the money to B. Now, you see, B here has not received the income, even though the income is accruing to him. He has not received the income. And so he is very likely to say that he won't pay any tax on the transaction. It's very, very likely. And it is called indirect payment. Meanwhile, he has still benefited from the payment, hasn't he? Isn't the money still to him?
Yes.
Yeah. So he is doing that purposely to probably dodge the tax payment on the transaction. So we said that this is a provision that deals with a situation where a person indirectly benefits from a payment, or where a person directs another person to be the payee of a payment, and the payer intends the payment to benefit the person who gave the directive. So in such a case, you are trying to do an indirect payment. Now, when you have such situation, the Commissioner General, through practice notes or notice in writing, can treat that person, this person, as the payee, the one who is supposed to receive the money, and therefore should pay the tax. So basically, that is what we are trying to say. So if you have any situation like that in your exam, try to find out who is the first beneficiary of the money and who is supposed to pay the tax. All right. So that people don't direct payment elsewhere and say that they've not earned an income to actually pay the tax. All right. So that is that. Any question?
As I see the indirect payment to be difficult in reality.
Yeah, it's difficult in reality for them to see, or for the Commissioner General to spot. Is that what you mean?
Yes, for the commissioner to be able to identify that.
Yeah, but you see, that is where my research comes in, where electronic comes in. Because the electronic will, if every invoicing is done electronically, there will be an invoice between these two people. And if everything is digitalized, there will be a payment to this person. And of course, if everything is digitalized, we will know that this guy is related to this person. And the invoice, the money paid to this guy will be the invoice amount. You see, these are things that is my research that I want to, very soon it will be published. Very soon you'll see it. All right. So that is the issue. You are saying it is very difficult because of the manual system we still keep in place. That is the thing. Yeah, it's very, very, very difficult for them to see. Very difficult in reality, as it is in our nation, Ghana now. We've not fully, but you see what? The truth is that if you remember our tax administration, we learned that the Commissioner General must get to a point where there is information sharing among the divisions. Yeah, but you see, right now, NIA has information. Why is it that it is not with GRA? Why is it that there's no interconnectivity of data? And they are all the government. So you are right. Very difficult to spot at this time. But I don't think that is how it is in the Western world. because it is assumed that even when you go to the hospital, you don't show, you don't tell about your family. They can just know about your card and they can locate your family. Yeah. Here is very, very difficult because even our birth set linkage to, and the information that the technological advancement is low now. Yeah, so that is that. That is that. All right, so basically that is that. Then we go to the very difficult one. This one is arm's length transaction, and we are going to talk about it as transfer pricing. So we want to look at that in